Welcome back, folks. This is Open Exchange. You're watching us live from the CNBC-TV18 Motilal Oswal studio right here in Mumbai, and we're talking about how to approach the markets today. Despite it being Friday the 13th, looks like it's going to be a good start to trade considering all the cues that we have. Mitesh Thakkar and Shrikant Chauhan have been sitting by with us, and the SGX Nifty is also indicating a green start. Mitesh, let me come to you. What would be on your buy and sell list today, and how are you approaching the IT names after the numbers that came through?
Yeah, IT, is showing some signs of bottoming out. I think we have still not got a confirmation of that. But if you look at the charts of Nifty IT, the idea is that after the decline in the last few weeks, there has been good base building around this 28,000, 28,500 mark. I would want to see the Nifty IT get past 29,000, 29,150 to suggest some kind of a trading reversal and a bounce back to about 30,000 plus levels. So waiting it out, but yes, I think it's oversold, it's consolidating, so the fall is stopped. I think a breakout should add to the upside momentum. Once that happens, about 29,000, IT stocks will be in the focus. But for the time being on trading side, I have a mix of buys and sells, 2 buys and 2 sell calls. On the buying side is Ultratech Cement. It has been a call earlier as well. Good consolidation, pullback, and then a breakout on the upside yesterday. So buy here with a stop at 7,100 and look for targets of around 70 to 75. And the other stock is M&M, clearly a very strong outperformer. That's a buy with a stop at 1305 for a first target of around 1350. On the sell side is Tata Consumer. Some kind of a negative breakdown happened there yesterday. So keep a stop at 766 here and look for targets of 730. While Granules, that's the final sell call. Sell here with a stop at 325 for a trading target of 305.
Okay, all right. Mitesh, got that. Shrikant, what about your picks for the day?
Yeah, I think till the markets are not crossing the level of 18,000, we need to focus on those stocks which are not part of index. And in that, we like SRF because the stock was around 27, 2800 levels. From there, all the way it corrected back to the levels of 2200. So certainly at this level, the risk reward ratio is quite favorable for SRF. It's a buy at current levels with a target of 2,300. We can keep stop loss around 2170. And the other stock which we like is Birla Corporation. And there also we feel that the stock is forming some triangle formation. From here, the stock can easily move to the levels of 1060, 1070. Currently, it is at 980. We can keep stop loss at 950.
Okay, thanks a lot for that, gentlemen. Have a good Friday and a good weekend. We'll, of course, come back to you for more. We also have some FNOQs coming through this morning. Chandan Taparia, who's the derivative and technical analyst at Motilal Oswal Financial Services, is joining in. Chandan, a very good morning. How are you positioned? Are you, expecting a green tick? And if yes, what are the stocks to look at today?
Good morning, Sonia. Thanks for having me. So market got stuck in a range where sustained selling is not there, but bounces are being sold. We have noticed that in last 15 to 17 trading session, the Nifty has been moving in between 17,777 to 18,250 zone. And in between, the resistances are slightly shifting lower. We have seen that even after breaking the important level of 17,777, it just fell by 10, 12 points and turned higher to 17,850. So that clearly visible that buying interest is there, but that is only happening on the decline. So we believe that such kind of range-bound bias and swings in broader range could be there in the market. So for the day now, if market manages to hold beyond 17,950, then only the immediate negative will get out for the next move towards 18,250. If 17,950 is not surpassed, then we have to again play the range with support near to 17,777, 17,750 level. Talking about Bank Nifty index, that has measured support near to 41,750 to 41,500. So both the indices are near to key support level, but not getting sense about any kind of bottom out and not getting sense of a decisive move on either side. And might be the market is waiting for more corporate result and any pre-budget kind of sentiment to cheer or drive the setup. Even if I look at the data setup, long short ratio from FIs is 40%, PCR is hovering below 1, VIX is near to 15. So that is also not giving major conclusion and somehow indicating about the broader range-bound bias of the market. Now talking about the stocks, so advanced decline ratio is slightly negative, but we have noticed that selective capital goods, metal, few auto, few banking name are holding well. So here as a theme as well as for momentum, we have selected to be with capital goods name. So first that is buy on L&T. This is stock has taken support near to 50-day exponential moving average. In last month to this month, we have seen 96% rollover and thus longs are intact. So major trend is positive, consolidation seems to be over and some uptick are there, so momentum could continue. So we are recommending Larsen and Toubro with a stop loss of 21.20 and looking for an uptick towards 20 to 50 level. Second trading idea, that is buy on Cummins. A correction of 2 to 3 weeks is now getting over. The stock is holding well even when market is falling down, that clearly showing the relative strength and the resilience of the stock against the market decline. 90% rollover and 6 to 8% open interest addition in last two trading sessions clearly indicates that longs are heading. So recommending to buy on Cummins for an upside target towards 15.40, and one can buy with a stop loss of 14.50 level. So L&T, Cummins, and major support of Nifty near to 17,777 zone.
Okay. Well, thanks a lot, Chandan. Have a great day. Have a good weekend as well. That's the F&O space. But I think the big tech earnings are going to, dominate Mindspace this morning. Infosys reported a beat on its top line in the third quarter. Margins were a slight miss, though. The biggest takeaway is that the company revised its FY23 revenue growth guidance upwards from 15 to 16% earlier to 16 to 6.5%. My colleague Ritu Singh, in fact, caught up with Salil Parekh, who's the Chief Executive Officer at Infosys, and began by asking him on why they raised the guidance despite all the challenges. Listen into what he had to say.
So on the guidance, we've had a very strong large deals win for Q3, and we've had very strong growth in the quarter, 13.7%. Keeping those factors in mind, and also looking at the points where some of our industries we are seeing a different economic environment. For example, in financial services, in mortgages or investment banking, in telco, in high tech, retail, so on. Keeping both all of those factors in mind, we've increased the guidance. Specifically on Q4, we don't provide a quarterly view of that. We only have an annual guidance.
That's right, but the implication is because you revised up the guidance for the rest of the year, will we see a bit of a muted growth? And also, if you could comment on, the EBIT margin, you expect to be at the lower end of what you guided?
On the Q4, so first, with the change in the guidance, typically Q3 and Q4 are seasonally weak quarters for Infosys in any case. So those factors still continue. On the margin, we had a very good operating margin in Q3 at 21.5. We've kept the guidance, which was narrowed to 21 to 22. We've kept it at that level, and we've also I made the statement in the comments earlier. It'll be at the lower end of the guidance.
Okay, all right. Well, let's take that discussion forward then. Manik Taneja of Axis Capital joins us to discuss the whole host of tech numbers that we have got. Hi, Manik. Good morning. Thanks for joining in. Manik, the Infosys numbers look good. Revenue growth beat, good deal wins. They've upped their guidance. Margin a little bit of a sore point out there. But what's your sense on the stock from here on? Because there is still uncertainty globally. Go ahead.
So good morning, first of all, and thank you for having me on the show. With regards to the earnings that we've seen across the sector, we've had 3 tier 1 companies report until date for the quarter. And across most companies, growth has been better than what the street feared. And the same thing essentially was true even for Infosys. One can certainly call out that the growth to some extent was led by some pass-through software revenues, which impacted margins negatively. But in the overall scheme of things, growth is still holding up quite well. You've seen growth being led by Europe, which everybody has been much more worried about in terms of how the macro impacts the business in that geography. And from an underlying internal metric standpoint, what you would expect in terms of moderation, in terms of hiring, attrition essentially is the trend across all the companies that have reported. As such, with these numbers, I would doubt if the street would cut numbers as such, and earnings downgrade certainly is set to take a pause, if not a reversal for the companies.
Okay. On HCL Tech, the numbers are fine. I mean, there's a positive surprise on margins, but HCL Tech has actually narrowed its guidance, so reduced its guidance a tad bit on the revenues and the margin front. Would that be a concern to you, or it's something that the management in any case highlighted mid-quarter? But what do you do if you're a shareholder here?
Sure. So as you rightly pointed out, the change in terms of that band, both from a growth and especially from a growth standpoint, is an extension of what HCL Tech called out during the US Analyst Day, when they had suggested that they might be at the lower end of that 13.5 to 14.5% growth outlook at that point of time. So that growth outlook essentially is being fine-tuned now toward a 13.5 to a 14% CC growth. So not an incremental negative in my view. From a margin standpoint, given where street expectations are or have been for the company, and the fact that HCL Tech had been suggesting that the margins might be at the closer to the lower end of the indicated range of 18 to 19%, that is driving the slight reset in terms of that margin band. So I would say the guidance change essentially is a non-event in my view. From an underlying metric standpoint, pretty similar trends as one what saw at TCS or Infosys. Order booking being fairly strong, even for HCL Tech, 3 large deals accounting for TCV of $1 billion plus in that order book number.
Okay. All right. Manik, I wanted to ask you, we have the initial rates that are coming there. Infosys has opened up mildly higher. HCL Tech is under some pressure, down 2.5%. Do you track LTTS?
So LTTS is a name that's covered by my colleague, not covered by me.
Did you have a chance? I mean, what's the call from your brokerage about this particular DM? Because it seems the street doesn't like it. Large part of their cash is going to be utilized to buy this company. It's a group company as well, and margins will be lower. The stock is opening up with a cut of around 2%. Just want to know, as a house, what's your view on the deal?
So certainly, as you mentioned, basically an acquisition of a related party, and from both a growth margin profile and a focus standpoint, very different from the existing or the native L&T tech business. This acquisition, essentially, the way L&T essentially is suggesting is that this is a capability acquisition, and they want to essentially take these capabilities to the international markets. We'll have to see as to how this works out, because finally this will mean that they will pivot towards more services mix going forward from an international standpoint, and thereby the expectation that margins should also improve. Certainly, yeah.
I got that, Manik. We'll leave it there. Thank you very much. Just running into market opening. Appreciate your time here on CNBC TV18. It's 9:10. Mitesh is with us with his 9:10 calls. Mitesh, what do you have? I mean, the pre-open is indicative of a slower kind of start. May not be the worst thing in the world. Go on.
But I think the breakout which happened on Ultratech yesterday has a good chance of follow through. So I'll pick that stock. A stop loss of 7,100 here or just below that, and a target of 7,275 on the upside.
Okay, long on Ultratech, and the breakout perhaps will hold. But what's the brokerage standout report now? Nimesh is joining us to tell us that. Nimesh, hi.
Hi, Prashant. So today's standout is on Midcap IT, a big report from Macquarie, almost 157 pages. And the big theme is digital transformation. They believe a change in IT spending is underappreciated by the consensus, and that's why they've put the top pick in the mid-cap IT is now Persistent and L&T Mindtree. Overall, for the sector pick, it's HCL Tech, but for mid-cap, now it's followed by Mindtree and Persistent ahead of TCS. I'll just quickly run through the target prices and all the mid-cap names. On Persistent, there were target price of 8330. Yes, 105% upside from current levels. On Mindtree, there were target price of 7540, a 75% upside potential. On Coforge, there were target price of 6260, a 60% upside. On Birlasoft, target price of 500, another 65% upside. On Mastech, there were target price of 2720, 57% upside from current levels. And on LTTS, there were target price, which is a potential of 20%. The only neutral that they have in mid-cap IT is Emphasis, and there they have a 6% downside target. So their target is 1880. But a big report on mid-cap IT and big target prices on the likes of Persistent and L&T Mindtree from Macquarie today morning.
I mean, I think only yesterday or day before, Nimesh, didn't JP Morgan had a kind of a report out on ER&D and Persistent, etc. was the other side, right? They were underweight.
They are underweight. They are underweight on Tata Elxsi as well as on LTTS.
Yeah, I saw mention on Persistent as well. I mean, but that's the market, right? All kinds of views, different kinds of views. That's what make the market. Thanks very much, Nimesh, for that. Well, Gujarat Gas is a stock which could be in focus. Jeffries has got a note out. Mangalam is here with more. Mangalam, hi.
Good morning. So Jefferies has downgraded Gujarat Gas and they've cut their target price from 570 rupees to around 400 rupees odd as well. The reason why they do that is because their outlook on spot LNG prices is rather firm. In fact, they see a structural drag on the company's pricing power, margin outlook and volume growth in the medium term. As a result of which, they've cut their volume estimate to 17 to 15% for the next couple of years. They've lowered their EBITDA guidance or expectations by about 15% as well due to lower volumes and compression in the margins, and they expect the company to deliver no more than just 5% compounded, earnings CAGR over the next 3 years. So that warrants a downgrade.
Okay, all right. Thanks very much, Mangalam. I'm going to pick up something from your sector, which is the exhibition space today on Market Laser. And I'm talking about PVR. It's got news flow as well, which we reported exclusively. We broke that the NCLT has approved the merger of PVR and Inox. Now, this is a chart which is a simple rising trend line all the way from away from the lows of 2020, and the next touch point is 2021, extended to where we are yesterday. We, by the way, put out PVR on the 20th of December right here on Market Laser. 20th December, the price was 1845, and back then we pointed out to exactly this trend line. From 1845, over the next 7 odd days, the PVR stock dropped 12%, 12.5%, all the way to about 1600, which was the recent low. That happened very, very quickly. Now, the reason I'm putting this up once again is because as of yesterday, after yesterday's price action and the news flow, the stock is basically trying to come back to that same level. I mean, a cross above this perhaps will rekindle the fact that maybe things get better for it. But if there is another failure, and that is also possible, right? It's entirely possible that it fails here. Then you are basically looking at further continued downside risks. There is fundamental news flow, but I think on the charts as well, this is a very, very interesting setup, knocking at that trend line all the way from the 2020 June lows. Sonia.
Okay, I thought you were going to talk about the movies that are releasing, and there's a big one releasing. Pathan is releasing end of this month. I mean, leave that for perhaps, the later part of Friday. So okay, well, the first tick on the index is absolutely flat. So sensex and the Nifty very quiet. The mid-cap index is up about 35 odd points. The first tick on Infosys is in the green, post its numbers, so up about half odd percent, not too much really. It's kind of a subdued positive opening for Infosys. But HCL Tech is down about 0.7%. So there's a bit of a red tick over there. So these are two disparate moves coming in the large caps in the IT space. The market is now inching towards the red. So let me tell you what's putting pressure. There's HDFC, there's Reliance. There's HDFC Bank that comes out with numbers tomorrow. In fact, even Avenue Supermarts comes out with numbers tomorrow, so just keep an eye out on that. There's Eicher Motors that's down in the red. Something like a Bharti Airtel, Asian Paints, Hero MotoCorp, M&M. All the auto stocks are down in the red this morning, so there's some selling pressure there. Now the Nifty is about 25 points in the red. Nothing alarming, but just goes to show that the market is still quite vulnerable despite all the positives that we have this morning. On the upside though, it's metals that are leading from the front. Hindalco, Tata Steel, JSW Steel in the green. UPL is up about 0.5%. Bajaj Finserv, SBI Life, Kotak Mahindra Bank, Divi's Lab. Okay, there was a steep fall in the last many days, but trying to sort of find its feet this morning. Divi's Lab up about 0.2%. But otherwise, the market, the advance decline ratio is well in favor of advances. So, in that context, it's not such a bad opening. It's a quiet, subdued opening with a bit of a negative bias. But, the market is still quite vulnerable. I mean, despite so many positive cues thrown at it, it's opened in the red. So let's see how it goes.
Well, let's see whether or not we can hold on to that 17,800 odd. And if we can do that, maybe a 150 point rally could be possible on the Nifty, just going as per what the structure is suggesting. Well, a couple of stocks, though, they're getting hit hard. Jefferies, they have downgraded Gujarat Gas to underperform. They've cut the target price to 400 from 570. They've cut their estimates on volumes. The outlook on spot prices are firm. They see a structural drag on pricing power, so that one's down 4% as we speak. L&T Tech, they'll be acquiring the smart safe communication business of L&T for around 800 crores. The street doesn't like that. The cash is going to a group company. There's a third of their cash that's going out from there. And the margins on the acquired business, in all probability, will be lower because it's an India-based business and it's focused on India's state and central governments as well. So both those two have opened up in the red. What's doing well then? You have RVNL. Well, the good news continues. They bagged a small order, but the street likes that. So that stock's opened up in the green. GDPL Hathway, you had the EBITDA jumping up by close to around 16%. So let's see how that one's opened up. GDPL Hathway, margins came at around 16.3%. Well, that's opened up a little on the back foot. Anand Rathi, in the pre-open it was higher. So let's see what that one's doing. I think it got sold into actually. It was up close to around 2%. Now it's down close to around 2% as we speak. And a couple of these mid-sized IT companies like Birlasoft, well, that's doing pretty well as well, up close to around 2% as we speak. So we're approaching the 17,800 odd mark, 17,750 to 17,800. That must hold to give the bulls a chance. Let's see if that's possible. What else?
Already lower on Nigel, right? I mean, 45 points down on the index. So this is, typically I would say a softer kind of start is better than a big gap up because, there is some buffer for the market to pick up if it wants to. But it's a flat start and then there is a bit of a selling pressure straight off the bat which is coming through. So 17,812, this looks like continuation of what we've had now for the last, actually all of 2023 so far, the 2 weeks or so that we've been trading. Just look at the HCL Tech intraday. The HCL Tech intraday, it's already, by the way, it's failing to hold first of all. It opened lower. There was a 20-25 rupee reversal from the day's low. The stock became absolutely flat and now there is another round coming and this is all in the first 5 minutes. So it's down 12 rupees on the day, but it's seen about 40 rupees worth of price action already from the word go today. What else? Cyient is, I think, clearly showing strength. Out of the tech names, HCL, Infosys, Cyient is the one which I think is up about 3.5%. Cyient was up 4% yesterday as well going into the numbers, or actually around because the numbers came during market hours, but it was up 4%. There is CG Power, which is up 3.5%. It's coming up with large volume, so 305 on CG Power. Persistent is something which Nimesh was highlighting. This is, of course, Macquarie on mid-cap tech. Now, Persistent is the top volume traded gainer. It's not up hugely. It's up just 2% or so, but it's there. ICICI Pru is starting about 1.25% higher on decent-sized volumes. And what else? Action Construction, JK Cement, or a few others, which are in the 1.5% to 2% range. But volumes are, lacking still, so they're just about picking up. The one problem area for the market has been Reliance, and Reliance once again starts lower by about 0.75%, 24.53. And Reliance, again, technically speaking, is in an extremely crucial zone. It's got 11-12% weight on the index, and you want the stock to hold, do well, and not go the other way. But it's corrected from 2,800 levels a month ago. It's down to where it is. LTTS is down 4.5%. We highlighted that. So that's actually the big mid-cap loser in the broader market. And there is Varun Beverages, which is down about 2% as well. Varun Beverages has also come under some amount of selling pressure recently. So that's the broader lay of the land right at the word go. Sanjay Mukim is our market master today. He's strategist head India Equity Research at JP Morgan India. Sanjay, great to have you with us here on the program. Thank you very much for your time. How are things set up, Sanjay?
Good morning.
Are you a little more constructive as we start this year? Or are you of the view that after the very strong, relative strong year we've had in 2022, this will be a muted one?
Good morning. It's great to be on the show. I think the key is the relative performance. And, even last year, India, the index was within a 5% range on a YTD basis. But what you have seen is a significant outperformance of India versus EM, principally driven by the problems we had in China last year. That is now reversing, and it's a fairly obvious trade. It's been obvious to all our investors for a while that as China reopens and the economic momentum in North Asia starts to come back, the big trade globally in EM last year was to go long India, short China, and that is reversing. So from an investor interest, investor feedback point of view, that focus is shifted entirely to North Asia, to China. If you look at the market there, it's going up every day. The stocks arguably there are still cheap. And that is why we're seeing this incremental pressure on India. It is underperforming EM as China reopens. And this momentum, I think, at least in the near term, is likely to continue because the China reopening is still a process. It's not completed yet. There's probably still a lot more legs to go, both on the economy and the market. And until that sort of settles, I guess this phase of India remaining under pressure, a lack of interest in India is probably going to persist.
Okay. So when you say India remaining under pressure, Sanjay, good morning, Happy New Year to you. There are so many imponderables, right? I mean, there are higher rates, there is inflation, there is slowdown in growth, there's an impending recession as well, and we have the budget that's going to be thrown at us very soon. What do you see as the big trigger for the market, which could perhaps cause a turn in sentiment now for the upside?
Good morning, Happy New Year. I think I'll focus my answer on the global macro there, Sonia, a bit. Because what we're looking at through 2023 globally is slowing growth, across the world, in the US, in Europe, and possibly in India as well, accompanied by slowing inflation. And we're seeing this in data almost every time a new release comes through. Inflation numbers should continue to slow. But what we fear is that global central banks, and especially the US Fed, is not going to pivot so soon. That what the whole market is waiting for is dovish commentary from the Fed, which leads to rate cuts and possibly liquidity injection at some point. And we think that you will need to see some sort of market action, some sort of panic in markets before the Fed starts to pivot. And therefore, I think the biggest event in the life of Indian markets as well through 2023 will be the global monetary policy cycle, and the point at which you firmly believe that the tightness in policy is over, and you're now looking to some sort of dovish or monetary injection or rate cuts in the back half of this year. We can talk about the budget, but I don't think that's going to be a trend changer for the Indian markets, to my mind.
All right. Hi, Sanjay. Morning. The first few numbers out of the blocks were the IT names. How are you all reading it? You all have been fairly cautious on the space. You believe it has more downside?
Yes, we've been cautious on IT for a while, and this again starts with our consistent view that the global economy is slowing, especially in developed markets. So as companies in the US and Europe find it a tougher working environment, the growth in their IT spends is very logically going to slow. The debate you have with investors is whether this is in the price for the stock of IT companies. Are multiples low enough? And that's what we argue that they aren't. I mean, for many of the companies, they are either at or still slightly above pre-COVID valuations, whereas the top-line momentum is still slowing. And what we also debate with investors is whether the companies will be able to expand margins into slowing top lines, because that is what is forecast. That is, consensus estimates believe that IT companies will be able to restore their margins even though top lines are slowing, and that's what we are very nervous about. So neither the revision cycle nor the valuations are in favor for us from an IT pack, and therefore we stay with our negative view on the space for a while.
Sanjay, are the revisions argument in favor for the broader Nifty index or for the broader markets or stocks under your coverage? Or you think that is also, there's a bit of a question mark there as well? And revisions higher?
No, it is. I see what
Yeah.
Yes, I understand. Look, we saw that upgrade cycle in India as the country reopened from the pandemic and the lockdowns. That has ended a couple of quarters ago. The misses are actually broadening, and this is, of course, to do with two things. One, expectations are too high because the market went up, valuations went up, so forecasts went up, whereas the economy is now getting into a more steady state growth phenomena. So it's a fault of, I would say, sell-side exuberance or market exuberance and the economic momentum as well. But I don't see a return to upgrades anytime soon. In fact, launching into our year-ahead outlook, we are struggling to find broad business themes or broad sector basket which can argue for upgrade. At best, what we can say for a few sectors in India that the downgrades won't happen, but we don't see the cycle that we've seen in the last 2 years from a revisions point of view, a positive revision point of view.
Okay. There are some themes which are doing quite well, right? In the meantime, by the way, we're getting a good update from Kolte Patil, the realty maker, on the Q3 updates. Realizations are a bit on the lower side, but otherwise the numbers are looking quite good in terms of sales. The pre-sales data, collections have gone up, and the stock as well is up almost about 2% odd. Some of these themes have played out really well, Sanjay, whether it's defense, the electrification theme, electrification and autonomous vehicles, that is. Then you have renewable energy, you have real estate that has done very well. From this entire basket that I mentioned, anything that stands out for you as a multi-year upcycle?
Yes, there are 2 or 3 of these things that we like. We really like real estate, and we've been long our real estate view for quite a few quarters and now. We've argued that the increase in mortgage rates is absorbable in a way that, the affordability of houses has improved significantly because incomes have risen and prices have been flat to down, and that consumers and mortgage buyers may be willing or able to absorb whatever raise in mortgage increases we've seen. And I continue to argue that the real estate upcycle will stay for a while. It is, of course, a smaller sector in the context of the overall index and market, but that is a cycle we like. If you give us a longer-term horizon, then we like the light manufacturing industries in India, right, which will benefit from manufacturing gains to India, which will benefit from whatever government subsidies are being provided. But this is something that you have to be patient about. It doesn't happen in a quarter or two. But we can see in data, we can see in the trade data that India's light manufacturing industries, which could include auto anchors and many other things, are structurally gaining market share over time.
Sanjay, the hope is from an Indian bullish perspective is hopefully, class is permanent and the form is temporary and India bounces back. That's the equity markets. But what about metals? If China is going to be reopening, and we had a guest earlier today that said that they'll give them 15 on 10 in terms of giving them rating them on the reopening out there. If that's the case, the metal stocks will be in focus out here. And a couple of data points suggest that maybe, in fact, they could be good for more. As a house, you're bullish, right?
We are. We are bullish commodities in general globally. But I've been a commodity analyst for most of my life. And, frankly, picking cycles and picking tops and bottoms in prices is extremely difficult. Yes, the stocks are working because prices are rising. This could partly be because of the sentiment of reopening of China rather than the real demand-supply action. We will find that out in some time. But the debate, I think, for these stocks is that you cannot trade these on valuations. You always trade them on the momentum of spot prices for the commodity. At the moment, it looks like it will continue. But the risk to Indian estimates, to answer a previous question as well, is that most forecasts for India assume low commodity prices. And therefore, there is a margin expansion forecast for many Indian companies. So if you, on the one hand, believe that the cyclical trade on metals or commodities is likely to continue, we actually then, at the same breath, start to get a little bit worried about the margin outlook for many companies.
All right, Sanjay, we will, of course, speak to you at a later date, but it was a pleasure talking to you on CNBC-TV18. Thanks a lot for joining in, and have a great 2023. Well, let's move on. HCL Tech is the stock of the moment. It delivered a beat on revenues and margins. Its constant currency growth rate of 5% sequentially is the highest amongst its peers. Rima caught up with the top management of HCL Tech, began by asking them about the quarter gone by. Let's listen in.
We have the product business, which is going to be seasonally a weak quarter, Q4. I mean, like this quarter, Q3, the product business had a fantastic growth. So some of that will moderate in Q4. So that's the primary reason you will see Q4 is a little softer in terms of the overall growth rate. Otherwise, we expect healthy growth in services, and it'll get a little bit offset by the decline in the product business in the last quarter.
Okay, but can you give us an indication on whether the furloughs that we saw in Q3 will extend into Q4? In retail, you had indicated a ramp down of certain clients. Is that something which will spill over into Q4? Some more nuance on individual sectors and geographies in Q4?
Sure. I think, furloughs was a little higher in the last quarter. In spite of that, we delivered very good numbers. A little bit of that will spill over, especially Asia-Pac financial services. We see a little bit more furloughs in the JFM quarter. But that's all baked in. I think we've given a total guidance of 16 to 16.5 in the services business. All of that is baked in. And in terms of verticals, we've had some very strong bookings in the last quarter. Not only the O&D quarter, but even the July, August, September quarter, we had some excellent bookings, both in financial services and retail CPG segments, apart from broad-based kind of a growth. But the special call-out will be financial services. We've booked more than $1 billion kind of TCV in just large deals in financial services in the last couple of quarters. All of that will start flowing into the revenue numbers from Q4 onwards.
And the ramp down of the retail CPG client that you saw in Q3?
I think it's almost done. So, I mean, maybe you will find a Q4 a little bit, but from next financial year, we see a strong uptick in the retail CPG segment. And that's also enabled by the new bookings, which is a couple of deals that we announced. We announced ODP, we announced Mattel, both are in the retail CPG segment. Both of them will give us good headwinds, good tailwinds in the Q1 of next year.
Prateek, wanted to get the margin outlook for next year, FY24. This year's margin guidance is known now, but in this quarter, you've almost touched 20%. Do you think in FY24, EBIT margins for HCL Tech could be in the range of 19 to 20%?
Rima, good morning and thank you for the question. First of all, let me react to some of the questions you asked CVK in the last few minutes. I think, like I said, this is a quarter of 19s. Our revenue growth was 19.6% and our net profit growth is 19%. I think we should just celebrate that because it is a seasonally good quarter for the products. But on that seasonally good quarter, we have delivered a 19.6% growth because the same seasonality was there last year, same quarter as well. And, 19% profit after tax growth year on year. So I would celebrate that, and seasonality is seasonality, right? I mean, at the end of the day, if the product revenue went up $100 million this quarter, some of it will come down, maybe not 100 million, 75 million, whatever it is. And that will have that, but on a year-on-year basis, again, that will be the right way to measure it. So I would just want to submit that for the viewers and all the investors and analysts, because that's just seasonality. We have to bake that in, that is baked into our guidance, and that's the right way to look at it. Coming back to your question about profits, we have indicated in our US Investor Day just last month as well, that we are very focused on getting back to the comfort range of 19 to 20% EBIT at a company level. And that is what we are gearing towards. We got into that band thanks to the seasonality in the products business this quarter. And that is what we are aspiring towards. Whether we'll hit it in FY24 itself is something I'll hold the question for the next quarter. We'll come back and give you the guidance for FY24 the next quarter.
Prateek, while decision-making has slowed down, and this has been reiterated by all of you all, have we seen any deal cancellations? And is there a risk to your deal win momentum, which you're currently enjoying of $2.3, $2.4 billion?
So there is no deal cancellation for sure. Even, I don't think we said that there is a slowdown in deal making. Even after 9th December, when we came and gave you those additional bites, we said, deal wins continue to be decent. And that's what we announced yesterday. $2.35 billion is a very good number for us. And you're absolutely right. We have been in that narrow band of $2.5 billion every quarter on the trot for at least the last 5-6 quarters. So I would not say deals have slowed down. Yes, there are some. I mean, Europe is one geography we talked about, but at an overall level, we are not seeing a slowdown.
Okay, so Europe is the only geography which is challenged for you right now. CVK, do you think despite the macro and the uncertainty, FY24 could still see double-digit growth for you? Not getting you into numbers, but just wanted to get a direction from you and your thoughts on this.
So let me just add one small dimension to what Prateek said, since you talked about margins, right? Margins were also very good last quarter, 19.6%. Now, while a lot of contribution has come from the product business, what we have to acknowledge is there is a 70 basis points improvement in the operating parameters. So it's been an exceptional quarter of execution where we delivered efficiency in the operating model, whether it is freshers, automation, and better utilization, all of that. So I think that's really talking about the key levers that we have for improving margins, whether it is freshers, whether it is improving utilization, improving realization. All those metrics are a very, very sharp focus for us. And that was the logic of providing a roadmap of getting to 19 to 20% margin profile. Now, coming to FY24, I think at this point, we can only talk of certain leading indicators. If you look at even at the lower end of our guidance, I think we will have at least 2.5%, 2.5 to 3% kind of exit tailwind that will come. And on top of that, there has been some significant deals that we've announced. A lot of that will really deliver revenues in FY24. The one that we announced last quarter, the $1 billion very large deals that we won in this quarter, all of that will contribute to some good growth momentum. The third element is our hiring is not slowing down. We continue to hire. We added close to 3,000 people in this quarter. Our fresher projections for next year, we think we will hire a similar level of fresh talent to onboard into HCL Tech in the coming year. So these are all the leading indicators, and my pipeline continues to be pretty good. So you have to make your own assessment. I think all indicators are positive, and of course there is a macro, some discretionary spend will moderate, but there is a lot of counterbalancing factors like vendor consolidation, efficiency-led operating model changes, and cloud transformation, all of that. And these are all perfect sweet spots where we play in. And as I called out yesterday, Gartner is rated as, we are the only company in the leaders quadrant in all the 6 IT services magic quadrant of Gartner. So generally, we are in a very strong position to capitalize on the tech spend. That's really the outlook that I can provide at this point.
All right, that's the conversation with the HCL Tech management, but I have to say that the HCL Tech stock move does not inspire too much confidence because, it opened at the low point, which is about 1,040 today, and then it rallied to 1,070, right? That's a big 30 rupee move straight out, and then it's corrected all the way. It's back at the day's lowest point. So not really inspiring in terms of confidence. The other one is LTTS, right? That's a big 6% cut now, 34.26 on LTTS, and we'll revisit that a little later. There is also a sort of trend line technical break, which we will highlight, and that has happened just, the bulk of it today. But there's news flow, there, which the market doesn't like. Paytm is down 1.25%. These are some names which were not there in the mix earlier. L&T is starting. L&T has seen a few kind of positive notes from the sell side recently, but today it's starting about 1.6 lower, 2,124. Shriram Finance, of course, 2.5 lower. There was that block which we were talking about. Coforge is down 2.75%. L&T Mindtree, that is down 2% as well. So there's a lot of tech actually which is coming up with cuts. Motherson from the auto space is down 4% as well on decent sized volumes at this stage. Navin Fluorine is another one which saw a very large move yesterday. It was one of the largest volume-led movers, and that is starting down about 2% once again. So there's a fair bit of price action on the downside as well, which is led by volumes. We'll take a break here. We have the management of Galaxy Surfactants join us in just a bit to discuss their business outlook going forward. Later, we'll connect with Prabal Sen of ICICI Securities in terms of their expectation from the oil and gas sector ahead of the earnings. Stay tuned.